Imagine waking up one morning, checking your investment account, and seeing it suddenly grow by thousands of dollars. No lottery ticket, no miracle, just the power of choosing the right investment strategy. For many people, this dream feels far away. But what if the secret isn't actually complicated? What if the secret is simply choosing between two very different paths: active investing and passive investing? And what if the choice you make today could shape your wealth for the next 10, 20, or even 50 years? This is the story of a quiet financial battle happening behind the scenes. A battle between human skill and simple patience, between constant action and calm holding, between trying to beat the market and simply letting the market work for you. And believe it or not, millions of investors have strong opinions about which strategy truly works. But today, we're going deeper. Today, we're discovering the truth most people never learn until it's too late. To understand the difference, picture two drivers trying to reach the same destination: long-term wealth. The first driver is active. They're always steering, adjusting, switching lanes, checking the GPS, and trying shortcuts to arrive faster. This is the active investor, buying, selling, researching, reacting to news, and constantly hunting for opportunities. The second driver is passive. They choose one straight road, pick a comfortable speed, and stay focused. They don't chase shortcuts. They simply trust the path. This is the passive investor, someone who buys a simple fund that tracks the entire market and holds it for years. Both drivers want the same thing: to win. But only one strategy wins more often. Active investing sounds exciting. You try to beat the market, spot hidden gems, and outsmart other investors. Professional fund managers spend their lives doing this. They study charts, analyze companies, and react to every new economic update. But the question is, does all this effort actually pay off? Or is the market harder to beat than most people think? Passive investing takes the opposite approach. Instead of trying to pick the best stocks, you buy all the stocks through an index fund. You don't try to predict anything. You simply ride the wave of the entire market. And history shows that, over long periods, the market tends to grow. Here's where things get interesting. Most active investors, especially professionals, still try to beat the market. But study after study shows a shocking fact: over 80% of them fail in the long run. Imagine spending years researching, trading, stressing, predicting, and still losing to someone who simply bought the whole market and waited. That's the reality of active investing. But does that mean passive investing is always better? Or is active investing still worth it for some people? This is where the story becomes more complex, and where millions of dollars are won or lost. Active investing shines in certain moments. For example, when markets crash, active investors can quickly adjust. They can sell risky assets, buy undervalued opportunities, or protect themselves faster than passive investors. They can take advantage of short-term movements. They can capitalize on unique trends. And some legendary investors, like Warren Buffett in his early years, built fortunes by making strategic, active choices. But let's be honest, most people don't have the time, skill, or patience to study the market every day. And even with skill, the unpredictability of the market makes it extremely difficult to beat consistently. Active investing also comes with higher fees, higher taxes, and more stress. Imagine constantly worrying about your investments, checking your phone every hour, or panicking during market crashes. It can feel like a roller coaster you never signed up for. Passive investing, meanwhile, offers peace. It removes the pressure to predict anything. You simply invest in broad funds like the S&P 500 and let time do the heavy lifting. Historically, passive investors benefit from the steady growth of the overall economy. Companies rise and fall, trends come and go, but the market as a whole has moved upward for decades. It's simple, affordable, and incredibly effective for beginners and long-term thinkers. But here's a thought-provoking question. If passive investing wins so often, why do so many people still choose active investing? Is it because we believe we're smarter than the average investor? Is it because excitement is more appealing than patience? Or is it because we hate the idea of sitting still while others make smart moves? Tell me what you think. Why do you believe people still chase active investing? Drop your answer in the comment section. I'd love to see your perspective. Now let's go deeper. Imagine you put $10,000 into an actively managed fund and another $10,000 into a passive index fund. Over 20 years, the active fund manager charges higher fees, often 1% to 2% every year. The passive fund might charge only 0.03%. This small difference adds up dramatically. After 2 decades, fees alone could drain tens of thousands from your profits. It's like running a race while someone keeps adding small weights to your back. But here's something people rarely consider. What if you are the active investor? What if you're buying and selling based on emotions, fear during market crashes, or excitement during bull runs? Emotions are the silent enemy of active investing. Most people buy high and sell low without even realizing it. Passive investing removes emotion from the equation. The strategy is simple. Buy, hold, and let the market grow. But don't be fooled. Passive investing may be simple, but it's not easy. Watching your investments drop during a recession can feel terrifying. Holding steady while everyone else is panicking takes discipline. Many people claim to be long-term investors until the market drops 30%. Then suddenly they become active investors out of fear. Here's another question for you. If the market dropped 40% tomorrow, would you stay calm and keep investing, or would you panic? Be honest and leave your answer in the comments. Now let's explore which strategy works best for most people. Over long periods, 20, 30, even 50 years, passive investing has outperformed the majority of active investors. The combination of lower costs, fewer mistakes, and the natural growth of the market makes it powerful. But active investing still has its place. If you enjoy learning, researching companies, studying charts, and understanding the economy, it can be exciting and rewarding. Some people thrive on the challenge. But for everyday investors who just want their money to grow without stress, passive investing offers a straightforward path. However, there's a twist most people don't talk about. Many investors use a combination of both strategies. Some put most of their money in passive index funds for long-term growth, but they also keep a small portion for active investing, like picking individual stocks or taking advantage of short-term opportunities. This hybrid strategy allows them to enjoy the stability of passive investing while still exploring the excitement of active investing. Now here's a powerful question to think about. What kind of investor do you want to be? The calm, long-term builder? The hands-on strategist? Or a combination of both? Drop your answer in the comments so we can see the different perspectives from everyone watching. If you're enjoying this documentary so far, don't forget to like, subscribe, and share the video. It helps the channel grow, and it motivates us to create more amazing content for you. As we reach the conclusion, remember this. The best investment strategy isn't the one that sounds smartest. It's the one you can stick with for decades. Wealth isn't built by chasing the perfect moment. It's built by staying consistent. So whether you choose active investing, passive investing, or a mix of both, what matters most is that you stay committed to your journey. And here's one final question for you. Which strategy do you believe will work best for your future? Active, passive, or both? Leave your answer in the comment section so others can learn from your insight.